Here is something that has almost become common knowledge again, but I tend to disagree. Most people say when silver is up, when everybody talks about silver, then sell it. When everybody talks about Nvidia stock, then sell it. When it's your taxi driver and your aunt that starts to talk about the Bitcoin, then sell it. That's the common narrative, right? We should be selling when everybody gets hyped about some asset class. But I tend to disagree. This is only half of the truth. Because there are conflicting ideas here, right? There is the idea that being contrarian, being in the minority is the way to go, because the minority tends to make the money and the vast majority tends to lose money actively trading. But then there's also other sayings. For example, the trend is your friend. And that's the exact opposite, right? When everybody is buying into something, we should just continue holding it. Maybe we should buy even more. Maybe we should follow the momentum. So what's really correct here? Should we do the opposite of what most other people are doing? Or should we follow the trend? Should we follow the momentum? Here is my take on this. Momentum and trends are real. When we measure this, right, with backtests, for example, when we try to figure out moving averages, following the current trend makes sense. Something that used to go up is more likely to continue to go up. Something that used to go down is more likely going to continue to go down, at least in the short to medium term. Now, why is this potentially not true for the long term? It's because at some point there is an inflection point. So that's why I want to be contrarian. When everybody talks about something, we might want to be cautious. But just because some people talk about something, we might not be. So really, it's about a saturation point. The market is saturated at some point. When the price is going up, this is actually a self-reinforcing loop. So prices appreciate, that creates attention. Attention creates more buying pressure. As we've got more buying pressure, the price goes further up, which creates even more attention. So you've got a reinforcing loop. More price appreciation creates attention, more attention creates more price appreciation. This continues until we do not have additional players entering the space anymore. So we get a trend that establishes further and further, and at some point there's simply not enough new people entering to further propel that trend. And that's then when things turn around. When everybody talks about something, then probably we are close to the saturation point. The question though is, what does it mean? Everybody talks about something. Can we really time this properly? Really, we want to be part of the party. We want to join a positive trend. The only thing we don't want is to be the last at the party. We don't want to be holding the bag. We don't want to be in the market when things suddenly turn around. And how can we achieve this? Really, by being more informed, by being more actively informed than the average market participant. If your aunt is suddenly asking you about buying silver, and that aunt normally never talks about investments at all, then probably a lot of the total addressable market for short-term investment hype has already been covered to a large extent. So really, if we follow the market more regularly than the average market participant, then we can spot the trends earlier. If we just follow as the vast majority does, the vast majority enters at the end of the trend, right? Because again, this is self-reinforcing. At the beginning, it's only 5 traders. The price is going up. Then it's 10 traders. The price is going up. Then it's 100 traders. The price is going up. At some point, when it has reached the average investor that's normally not interested in the topic, it's already so many traders, it's very hard to find new people to enter. And that's the inflection point. And so to be early, to be not part of the vast majority that enters at the very end, in order to be early, we just have to be informed regularly. We have to think about those things more often than most others. So when everybody talks about gold and silver, and you're supposed to sell at that point, the key word here is everybody. Really, we need to have many people covering the topic, people that normally don't talk about those things at all. How can we figure out when things might be turning around? I think comparisons help. So logical comparisons. Let's say we look at different kinds of money. We look at fiat currency versus precious metals. Those are simply different ways to transfer money, to store money. We could just compare how much attention, how much capital is currently in those different asset classes. Instead of looking at the gold price, just in US dollars, we want to look at the gold price relative to the fiat base. So we divide the gold market cap by the market cap of fiat currency. So gold market cap divided by, say, USM2. And suddenly we get a much cleaner picture of at what point in time gold might be expensive versus cheap. So really, we are looking at capital rotation. When are people very risk off? When do they want to be in gold? And when do they rather want to be in fiat currency to deploy this quickly in other assets? There's similar ways to value stocks, for example, right? We can have a look at the Shiller price to earnings ratio. How expensive are stocks currently relative to their future earnings? Or we can have a look at cryptocurrencies, right? How expensive is a particular cryptocurrency relative to the entire market or relative to Bitcoin? With those relative valuation charts, we now get an idea. How is capital actually shifting? Where might we potentially be overextended? Something that we don't necessarily get from US dollar charts. There is this other very popular saying that I disagree with. This idea that past returns do not indicate future returns. Now, sometimes this is just said as a disclaimer, right? Let's say somebody tries to sell you a mutual fund, and the mutual fund has historically returned, say, 15% per annum. That does not necessarily indicate that it will return 15% per annum in the future. So very often it's just a disclaimer, but sometimes it's actually meant that way, that we can't predict future prices based on prior price behavior. Now, I tried to figure out if that's actually true. So I made a back test here. I made an analysis here. I looked at the price development of the S&P 500 over more than 100 years of data, and I looked at time windows. So I looked at a certain point in time and I checked what was the performance in the 1 year prior to that point in time and what was the performance in the year afterwards. So we look at the past 1 year, we look at the future 1 year, and we do a rolling analysis. How much did the prior year performance impact the future year performance? Is there some kind of connection, or is this really completely random? If we run this through a scatter plot, so it becomes now a bit technical, right? But what I'm trying to do is I try to find a connection. On one axis, we've got the prior year performance. On the other axis, we've got the future year performance. We scatter this on a plot. We try to figure out, is there a connection? We actually do have a connection. For the entire data set, there is a slight positive connection. So if we have a positive year in the past, it tends to be also a positive year in the future. But there is an even stronger connection if we segregate the data. If we just look at the prior year when it was negative, we check how did that influence future prices. And when we look at the data set when it was positive in the prior year, how did that impact? If we look at the only negative years, so in the last year, we had negative price performance in the S&P 500. And we check how did this relate to the year afterwards. What we find out is that the more negative the prior year was, the more positive the future year tends to be. So there is an inverse correlation, interestingly enough. In other words, it does make sense to buy the dip. When we have crashed in the stock market, we should allocate towards stocks more than we usually do. If we find a way to buy the stock market more after a crash, maybe we sell some of our other assets, maybe we sell our car, maybe we save a bit more, we don't consume as much, and we just buy the dip more than the average person during a crash, then we tend to make more performance going forward. This has been true for more than 100 years of S&P 500 data. So how does past performance impact future performance? In general, if things are positive, they are positive. But if we crash, there is an opportunity in here. We tend to have outsized performance going forward after a crash. Buying the dip does make sense. There is a connection here. It's not just random. And so what we learn from this, if there is a stock market crash, the worst thing you can do is to sell. The worst thing you can do is to panic. The second worst thing to do is to just freeze and do nothing. And the best thing to do is to take advantage of those lower prices. The further we crash, the more exposure we want to have. We want to start buying with our savings Once we have bought with our savings, we want to potentially increase our exposure by increasing beta. So maybe we move from regular stocks to tech stocks, right? If we crash further and we then move from the regular to the tech stocks, we tend to also see a stronger recovery, right? Whatever crashes most tends to recover most. And once we've done that, we might also even consider taking out a personal loan if we can serve that loan easily, of course, right? We don't want to get to any financial struggle, right? Leverage and debt, it works like fire. If we take a little bit of it, we can start cooking. If we have too much of it, it burns our house down. So you have to be smart with that. But there is a way to take advantage of those points in time. If we have crashed a lot, the expected return historically has been much, much higher post-crash compared to just a random year. And that's why it might make sense to even take a loan. If that loan is 5 or 6% per annum in interest rate, but our expected return post-crash is rather 20 or 25%, then why not take that risk if we can afford to take that risk, if it's easy for us to serve that loan, to make the payments. And so we just increase our exposure, right? We buy the dip with cash, we increase the exposure in terms of market exposure, going from the S&P 500 to the NASDAQ 100. We might sell stuff, we might downgrade our lifestyle just to save more, to buy even more. We might take out a personal loan as we crash even further. And in the end, we can go really risk on. We can go to potentially even 3x levered ETFs. So let's say we only bought VOO or QQQ, so S&P 500 or NASDAQ 100 ETFs. We can then, after we've crashed 60, 70, 80% in the stock market, we can then go even 3x levered. Imagine that, right? Imagine buying 3x levered ETFs at the bottom of a bear market. And you're doing that based on borrowed money because you've got a regular cash flow and you can serve that loan easily. That's really how winners are born. Winners are made during a crash. Crashes tend to be great opportunities. So really, it's important to have a plan what to do when a crash happens. It's important to lay this out nicely. Most people do not have a plan. They simply just ride through it. They simply just forget about the market. They don't look at their portfolio. They see all the red because of the losses of the existing portfolio. They don't really think about increasing even risk exposure. They don't really think about buying even more or even taking more risky assets. Most people do the exact opposite. Most people panic sell. And that's why most people don't make money. If you got some value out of this video, feel free to give it a like. Feel free to also check out the playlist. There's a playlist with many videos just like that. It's in the mindset and strategy section. Just click on the icon here on this channel, go to playlist, and feel free to binge watch just those videos in case you get some value out of them. Thanks again for watching. See you next time on YouTube. And of course, see you also in the premium membership if you're interested in how I personally manage my money. See you next time. Cheers.